Your credit score knows you better than your therapist. It sees every late payment, every maxed out card, every desperate midnight application for emergency cash. You think you're hiding your financial chaos behind closed doors, but those three digits are tattling on every bad decision you've ever made. Your score is watching. Your score is remembering. Your score is judging. But what if I told you that the number you've been obsessing over isn't just measuring your ability to pay back loans? What if your credit score is actually a psychological profile, a financial fingerprint that reveals the deepest patterns of how your brain handles money, stress, and self-control? You probably think your credit score is about responsibility, about whether you pay your bills on time and keep your debt low. That's what they want you to believe. But here's the plot twist that financial institutions don't want you to know. Your credit score isn't just measuring your creditworthiness, it's measuring your behavior patterns, your emotional responses to stress, and your ability to delay gratification. It's a window into your soul, wrapped in an algorithm. Welcome to the hidden psychology of credit scores, where every point tells a story about who you really are when money gets tight. Picture your credit score as a financial lie detector test that you're taking every single day. Every swipe, every payment, every financial decision feeds into this invisible machine that's building a psychological profile of your money personality. And the scary part, it's more accurate than most personality tests you've ever taken. Researchers have discovered that credit scores correlate with everything from relationship success to job performance to how likely you are to take your medication. Your credit score isn't just predicting whether you'll pay back a loan, it's predicting how you'll behave in almost every area of your life. Let's start with the most obvious revelation. Your payment history makes up 35% of your credit score, and it's basically a stress test for your brain under financial pressure. When money gets tight, do you prioritize your obligations or do you freeze up? Studies suggest that people who consistently pay on time, even small amounts, show higher levels of conscientiousness and better emotional regulation than those who miss payments. It's not about having money. It's about having systems. Your brain either creates order in chaos or it crumbles under pressure. Every on-time payment is your prefrontal cortex winning against your amygdala's panic response. Every late payment is stress winning against planning. The mechanism is simple. Financial stress triggers your fight or flight response, flooding your system with cortisol. Some brains can still execute logical decisions under this chemical storm. Others short circuit. Your payment history is essentially a record of how many times your logical brain beat your panicked brain in a cage match. But here's where it gets really interesting. People with perfect payment histories aren't necessarily better with money, they're better with systems. Research indicates that individuals who automate their finances show different brain activation patterns than those who manually manage everything. The automated group shows less activity in stress-related brain regions when thinking about money. They've essentially hacked their own psychology by removing the emotional component from financial decisions. One study tracking over 50,000 consumers found that people who set up automatic payments had credit scores that were on average 40 points higher than manual payers, even when income and spending were identical. Your payment history isn't measuring your wealth, it's measuring whether you've figured out how to outsmart your own emotional brain. Money flows like water, and some people build dams while others try to catch it with their bare hands. Now let's talk about credit utilization, the second biggest factor in your score. You're supposed to keep your balances below 30% of your credit limits. But what does this really reveal about your psychology? Your credit utilization is basically a measurement of your relationship with future you. Low utilization means you're thinking about tomorrow. High utilization means you're borrowing from your future self to solve today's problems. It's the financial equivalent of eating your seed corn. When you max out your credit cards, you're not just spending money you don't have. You're revealing that present you doesn't trust future you to handle problems. So present you is grabbing all available resources right now. Studies show that people with chronically high credit utilization have different activation patterns in the brain regions responsible for future planning. They literally process future consequences differently than people who keep their utilization low. The psychology gets even deeper when you look at the patterns. People who consistently maintain low utilization across multiple cards show what researchers call high cognitive load management. They're mentally juggling multiple financial obligations while maintaining awareness of their overall position. It's like playing financial chess while others are playing financial checkers. Your utilization ratio reveals whether you see credit as a tool or as a lifeline. Tool users maintain control and planning. Lifeline users are drowning and grabbing whatever floats by. Here's the kicker. People with utilization rates below 10% don't just have better credit scores, they report lower levels of financial anxiety, better sleep quality, and stronger relationships. Low utilization isn't just good for your credit, it's good for your mental health. Because when you're not borrowing from tomorrow, tomorrow stops feeling like a threat. Your credit mix tells another fascinating story about your financial personality. Having different types of credit accounts for 10% of your score, but what it's really measuring is your comfort with financial complexity. Someone with only credit cards shows a different money mindset than someone who manages credit cards, a car loan, a mortgage, and maybe a personal loan. It's not about being better or worse, it's about risk tolerance and planning horizons. People who successfully manage multiple credit types tend to score higher on measures of openness to experience and conscientiousness in psychological assessments. They're comfortable with complexity because they've learned to break complex problems into manageable pieces. But here's the interesting paradox. Some people with perfect credit mix are actually financial control freaks who use complexity to feel secure. They need multiple financial instruments because they don't trust any single solution. Others are genuinely sophisticated financial thinkers who use different tools for different purposes. The research reveals something counterintuitive. People who maintain a simple credit profile with just one or two accounts but manage them perfectly often have better long-term financial outcomes than people who juggle multiple credit types poorly. Your credit mix reveals whether complexity serves you or whether you serve complexity. The sweet spot seems to be having enough diversity to show you can handle different financial obligations but not so much complexity that you're overwhelmed by the cognitive load. Financial health isn't about having the most sophisticated credit portfolio. It's about having the right level of complexity for your cognitive bandwidth. Know thyself, then build your credit accordingly. New credit inquiries make up 10% of your score, and this is where your credit report becomes a record of your desperation timeline. Every hard inquiry is a moment when you needed money badly enough to potentially hurt your credit score to get it. Clusters of inquiries tell a story of financial crisis. Spaced out inquiries tell a story of planned financial moves. Your inquiry pattern is basically a stress timeline written in credit checks. Studies indicate that people who generate multiple inquiries in short time frames show elevated cortisol levels and report higher financial anxiety for months afterward. The act of repeatedly seeking credit creates a psychological cycle where financial stress leads to credit seeking, which leads to more financial stress. It's like financial self-harm disguised as problem solving. But here's what's really happening in your brain when you're desperate for credit. The same neural pathways that activate during addiction also fire when you're financially desperate and seeking new credit lines. The anticipation of potential approval triggers dopamine release, while the fear of rejection activates the same brain regions as physical pain. You're not just applying for credit, you're putting your ego through a torture device. Research tracking eye movements and brain scans of people filling out credit applications shows that financially stressed individuals focus obsessively on approval odds while financially stable individuals focus on terms and conditions. Desperation literally changes what your brain pays attention to. When you need money, you stop seeing the details that matter and focus only on the possibility of getting approved. That's why people in financial crisis often end up with terrible credit terms that make their situations worse. The most revealing pattern in inquiry history isn't the number of applications, it's the time intervals between them. Random scattered inquiries suggest impulsive financial decision-making. Clustered inquiries suggest either smart rate shopping or financial desperation. The key is understanding which pattern matches your situation. Smart rate shoppers do their research, apply to multiple lenders within a short window and then stop. Desperate borrowers keep applying until someone says yes, often accepting terrible terms just to get approved. Your inquiry pattern reveals whether you approach credit as a strategic tool or as an emergency drug. The difference isn't moral, it's neurological. Some brains can maintain long-term thinking under financial pressure, others can't. Length of credit history rounds out your credit score, accounting for 15%, but what it's really measuring is your relationship with time and commitment. A long credit history shows that you can maintain financial relationships over years or decades. It reveals patience, consistency, and the ability to think in long time frames. People with extensive credit histories didn't just avoid screwing up, they actively maintained financial relationships even when it wasn't immediately beneficial. There's something psychologically fascinating about people who keep old credit cards open even when they're not using them. They understand that relationships have value beyond immediate utility. They're thinking decades ahead, not months ahead. But here's the dark side of credit history length. Some people with very long credit histories are actually financial procrastinators who never optimize their financial situations because change feels dangerous. They keep the same crappy credit card for 20 years not because they're patient but because they're afraid of making financial decisions. Length without optimization can indicate financial paralysis rather than financial wisdom. The research shows that people with very long credit histories but no recent positive changes often score lower on measures of financial confidence and higher on financial anxiety than people with shorter but more actively managed credit histories. Time alone doesn't create financial wisdom. Active engagement with your financial situation does. The sweet spot seems to be having enough history to demonstrate stability while showing recent positive financial behavior. Your credit history length reveals whether you're playing the long game or whether you're stuck in financial inertia. The goal isn't just to have old accounts, it's to have old accounts that you've actively managed well over time, because credit scoring algorithms can tell the difference between aged financial wisdom and aged financial neglect. Now here's where it gets really psychological. Your credit score isn't just a historical record, it's a predictor of future behavior patterns that extends far beyond borrowing money. Insurance companies use credit scores to predict claim frequency because people who manage money responsibly tend to take fewer risks in other areas of life. Employers use credit scores to predict job performance because financial stress correlates with workplace stress and decision-making quality. Even dating apps are starting to incorporate credit score data because financial compatibility is increasingly recognized as relationship compatibility. What your credit score is really measuring is your ability to delay gratification, manage complex systems, and maintain consistent behavior over time. These are the same skills that predict success in relationships, careers, and health management. People with high credit scores aren't just better at managing money, they tend to be better at managing everything that requires long-term thinking and consistent execution. It's not about moral superiority, it's about cognitive patterns that either support long-term success or undermine it. But here's the most important insight. Your credit score isn't your identity and it's not permanent. It's a measurement of learned behaviors, and behaviors can be changed. People who understand the psychology behind their financial patterns can deliberately rewire their money habits by addressing the underlying cognitive and emotional patterns. The goal isn't to have a perfect credit score. The goal is to develop the thinking patterns that naturally lead to financial stability and life satisfaction. Your credit score is essentially a report card on your relationship with future you. High scores suggest you're investing in tomorrow. Low scores suggest you're robbing tomorrow to pay for today. The beautiful thing about understanding this psychology is that you can consciously choose to start making decisions that your future self will thank you for. Every financial choice is a vote for the kind of person you want to become. Your credit score is just keeping track of which version of yourself is winning. Remember, this is just educational content and doesn't replace professional financial advice, but understanding the psychology behind your credit score can be the first step toward building the financial life you actually want. Because when you understand why you make the money decisions you make, you can start making different ones. And that's when your credit score becomes not just a measure of your past but a bridge to your financial future. So what does your credit score say about your money habits? What patterns do you see in your own financial behavior, and what would you like to change? Drop your thoughts in the comments below, and if this financial psychology deep dive opened your eyes to something new about yourself, make sure to hit that like button. Subscribe for more insights into the hidden psychology of everyday life, and share this with someone who might benefit from understanding their own financial patterns a little better. Your future self will thank you.